With the December meeting approaching, the Fed is imploding from within. A major split, the worst in 12 years, is erupting inside the Federal Reserve, and it could reshape global investment flows. Among 19 top policymakers, there are 11 completely different answers to one core question. This deep intellectual divide has suddenly thrown a shadow over what many thought was a certain December rate cut. At the heart of the chaos is one issue: the Fed no longer knows where the neutral rate actually is. Let Ultima markets break it down in plain English. The neutral rate, or R*, is like the cruise control speed of the economy. At this level, the economy moves smoothly, not overheating with inflation, not stalling into recession. It's the just right Goldilocks equilibrium, and for the Fed, it represents the destination of this entire rate-cutting cycle. But here's the catch: this destination is invisible, like dark matter in physics. You can't observe it directly, you can only guess, and at the September meeting, the guessing game blew wide open. 19 Fed officials provided estimates ranging from 2.6% all the way to 3.9%, a spread not seen in modern Fed history. Think about what this means. If the neutral rate is closer to 3.9%, then today's rate is already near the finish line. Cutting further risks stepping too hard on the gas and reigniting inflation. But if the true level is 2.6%, then the current policy is still slamming on the brakes, and the economy could break under the pressure. This puts the Fed in an extremely awkward position. When rates were above 5%, you didn't need complicated models. Everyone knew it was too restrictive. But now, each incremental rate cut is like driving blindfolded along a cliff edge. Every step forward doubles the risk of falling off. Philadelphia Fed President Paulson recently said outright that rates may already be very close to neutral, making her cautious about a December cut. This is the hawkish view: stop cutting now, or we're asking for trouble. But because the neutral rate cannot be measured, officials are scrambling for evidence to support their theories. Some point to Treasury yields and argue financial conditions are still too loose, implying rates should stay high. Others, like Minneapolis Fed President Kashkari, say AI will boost productivity and raise the neutral rate. Another camp argues the opposite: tariffs and immigration policies will lower the neutral rate, meaning the Fed should ease aggressively or risk economic damage. In essence, this academic fight over R* reveals something deeper. The Fed has lost its sense of where the US economy truly stands. That said, Ultima Markets wants to remind traders of one thing: no matter how heated the internal debate becomes, the Fed's real decision-making will hinge on inflation and employment, not theoretical models. As former officials say, no one actually sits around talking about R* all day in those meetings. But the message is clear: the era of automatic, predictable rate cuts is over. Every upcoming meeting will be a tug-of-war, with meaningful market consequences. And for global investors, this heightened uncertainty is itself the biggest macro risk. This is Ultima Markets. See you next week.